Have you ever heard of the widowmaker trade? In the world of finance, it is a bet so notoriously difficult and dangerous that it has wiped out countless hedge funds and traders. For decades, this trade has been shorting Japanese government bonds, or JGBs. Why? Because for over 20 years, the Bank of Japan has been on a mission to keep interest rates at rock bottom, making any bet against their bonds a losing one. But what if I told you that this long, quiet period might be coming to a dramatic end? The tectonic plates of global finance are shifting, and the epicenter might just be Tokyo. What's happening in Japan's bond market could unleash a tsunami across your own investments, whether you're in stocks, crypto, or real estate. This isn't just some niche financial story. It's a ticking time bomb that could redefine the global economic landscape. So stick with me as we unravel why the widowmaker might finally pay off and what it means for all of us. To understand the scale of what's happening, we need to go back in time. After Japan's infamous economic bubble burst in the early 1990s, the country entered a period known as the Lost Decades. Deflation became the new normal, prices fell, people stopped spending, and the economy stagnated. To combat this, the Bank of Japan, or BOJ, did something radical. They embarked on an unprecedented journey of monetary easing. They slashed interest rates to zero and then went even further into negative territory. Their main weapon, a policy called yield curve control, or YCC. In simple terms, the BOJ promised to buy an unlimited amount of Japanese government bonds to ensure that the yield, or the interest rate, on the 10-year bond stayed capped near zero. Think of it like a price guarantee. No matter how many bonds were for sale, the BOJ was always there, ready to buy them up to keep the price high and the yield low. This made borrowing incredibly cheap in Japan and flooded the system with money. This ultra-low interest rate environment had a massive side effect that rippled across the globe. Japanese investors, from huge pension funds to individual savers, were faced with a problem. Keeping their money in Japan earned them virtually nothing. So what did they do? They looked overseas. They became the world's largest creditors, pouring trillions of yen, converted into dollars, euros, and other currencies, into foreign assets. They bought up US Treasury bonds, European corporate bonds, Australian real estate, you name it. This massive outflow of cash, often called the yen carry trade, had a profound effect. It pushed up the prices of assets around the world and helped keep global interest rates relatively low. Essentially, Japan was exporting its low-rate environment to the rest of us. For decades, this system seemed stable. Japanese money fueled global growth, and the BOJ kept its promise to anchor bond yields. But now, the ground is shaking. The biggest change, inflation. After decades of deflation, prices in Japan are finally starting to rise, just like they have everywhere else. The official inflation rate has been consistently above the BOJ's 2% target. This puts the central bank in an incredibly tough position. Their primary mandate is to maintain price stability. With inflation running hot, the pressure to abandon their ultra-loose monetary policy and to raise interest rates is immense. And this is where the widowmaker trade comes back into play. Speculators are betting that the BOJ will be forced to give up its yield curve control. If that happens, bond yields will be allowed to rise freely. When yields go up, bond prices go down. So these traders are shorting JGBs, betting on a price crash. For a while, the BOJ fought back hard. Every time the 10-year bond yield threatened to breach its cap, the BOJ would step in and buy bonds with printed money, sometimes spending hundreds of billions of dollars in a single month to defend the peg. But this is like trying to hold back the ocean. The market forces betting against the BOJ are enormous. In late 2022, the bank made a surprise move, tweaking its policy to allow the 10-year yield to rise slightly, from 0.5% to 0.5%. The market saw this as the first crack in the dam. Then in mid-2023, they tweaked it again, effectively raising the cap to 1%. Each move was framed as a technical adjustment, not a policy change, but the direction of travel is clear. The BOJ is slowly, cautiously backing away from its rigid control. Why the caution? Because they know the consequences of a sudden move could be catastrophic. So what happens if the BOJ finally gives up and lets interest rates rise? This is the multi-trillion-dollar question. The first and most immediate effect would be felt within Japan. The Japanese government is one of the most indebted in the world. For years, they've been able to service this massive debt pile because interest rates were zero. If rates were to rise to, say, 2%, the government's interest payments would balloon, potentially triggering a fiscal crisis. Japanese banks, which hold enormous quantities of these government bonds on their balance sheets, would suffer massive paper losses as the value of their holdings plummets. This could create a banking crisis that would make the 2008 financial crisis look small by comparison. But the real global impact comes from the reversal of that yen carry trade we talked about. If Japanese investors can suddenly get a decent return, say 1% or 2%, on safe government bonds at home, why would they take the risk of investing overseas? The incentive to keep their money abroad vanishes. We could see a massive wave of repatriation, where trillions of yen worth of foreign assets are sold off and the money is brought back home to Japan. Imagine Japanese investors simultaneously selling off their US Treasury bonds, their European stocks, and their global real estate holdings. This would create immense selling pressure across virtually every asset class. US Treasury yields would spike, making it more expensive for the US government to borrow. Stock markets from New York to Frankfurt could tumble. The value of the Japanese yen would soar, creating chaos in currency markets. This isn't a regional issue, it's a global one. The unwinding of Japan's decades-long monetary experiment would be like pulling a critical Jenga block from the tower of global finance. The new governor of the Bank of Japan, Kazuo Ueda, is a highly respected academic, not a career central banker. He's tasked with navigating this minefield. He knows he can't keep rates at zero forever with inflation running hot. But he also knows that a sudden move could detonate the global financial system. So he is trying to thread an impossibly small needle, gently guide policy back towards normal without causing a panic. He's using vague language, signaling flexibility, and making small, incremental changes, all in an effort to prepare markets for the inevitable end of yield curve control. But it's a delicate dance. Any misstep, any sign of losing control, could trigger the very panic he's trying to avoid. The speculators are circling, waiting for their moment. They believe the BOJ's position is unsustainable. Mathematically, it probably is. The question isn't if the policy will end, but when and how. So what does this all mean for you? It means that one of the biggest, most predictable forces in global finance for the last 20 years is about to disappear. The era of free money, subsidized by Japan, is ending. This introduces a new and profound level of uncertainty into the market. It means that the risk of a sudden, sharp global market downturn, triggered by events in Tokyo, is higher than it has been in decades. This isn't a prediction of doom, but a call for awareness. Understanding this dynamic is crucial for any investor. The fate of the Japanese government bond is no longer just a concern for specialized traders in Tokyo. It's a story that affects the value of your pension, the price of your house, and the health of the entire global economy. The widowmaker trade has been a losing bet for a generation, but its day may finally be coming. And when it does, the shockwaves will be felt by everyone. Thanks for watching. If you found this explanation helpful, please hit the like button and subscribe for more deep dives into the forces shaping our world. Let me know your thoughts in the comments below. See you next time.